line by line. Every single transaction is the correct incentive for us to be a creative nation, and that our tax policy and regulation should be supportive of innovation. But those are simply the discussions as someone talking to policymakers and journalists, that those are the types of questions that occasionally come up in the discussion. And I'm sure Kim has a lot to say about that too when she talks. And so aside from that, there's also the Fbar disclosure. So FinCEN also requires, for the purpose of disclosing foreign accounts, let's say if I had a bank account in Switzerland, it would be the same disclosure form that I would need to disclose for my foreign holdings, if they're above a certain threshold. And this is a gray area actually for cryptocurrency. So they have made public statements that decentralized exchanges and also crypto wallets would not be subject to foreign disclosure because they're not considered a foreign account. However, there's never been sort of a outright publication that is saying that the centralized exchanges, if they're headquartered in another country, are those ones exempt from foreign account disclosures. So given that it's a gray area, we've sort of taken the conservative standpoint that it's sort of better to be safe. And if you do have large accounts on centralized trading platforms in crypto, that probably you want to look at the maximum USD value that you've held throughout the year. And if it is above the threshold of reporting, just to be safe, you probably want to file an Fbar report until there's very clear guidance about it in writing from the regulators. And so this is sort of
one question: why not report it? What does it matter if you don't report it? Just report it.
Yeah.
Does it matter?
Exactly.
Let's keep the questions for later.
Yeah. Any other interruption, we would have to remove the person. So please, let's give it for the end so we can have a smooth presentation.
Oh, yes. Yes, so that is exactly the view that we've taken, that it's just easier to file the report just to be safe about it. As I was saying before, so I head up the research and analytics department for TokenTax. So a lot of what I do is delving into the data, since as you know, Etherscan and all of these, the public transaction data is extensive and fascinating, both. So this is just the most recent sort of topic that we've been really digging into after DeFi summer, is sort of this idea of, what does the sort of, we've been throwing around what terms we should call it, if this is the crop life cycle, or this is the ecosystem of yam farming, or what the overall picture of different DeFi projects looks like. So if you were farming yam this is August 11th and 12th, when the price was increasing, so what did that look like? So we have when you started farming, and just to sort of point out an example here, I think with my mouse I can sort of, like, if we look at this dot here, just to give a good example, this is someone who started farming earlier in the month, and then exited sort of when the price looked like it was going to decrease for the tokens, and they probably had a reward that was somewhere around 1,000 in US dollars. And since it's a dark dot, this person would be a whale, where they had been farming a significant amount. And so this sort of gives just sort of the overall picture of what what individual traders were doing during that time period when the price was significant, right? And you see there are a bunch of people who, as soon as the price sort of reached this high level, these are the dots are when people claimed their reward and exited farming. So there's sort of this cluster here. And then, of course, when the price also was increasing here, some people who had started farming early then claimed their rewards on August 12th. And just so views like this, where we can dig into the data and see the overall picture of what did yield farming really look like in retrospect. Sort of hindsight is 2020, and where were the who were the real winners, the lucky ones, and perhaps some folks who were unlucky in their gains. So this is the fascinating part, and you'll see some of these individuals probably are going to have significant tax bills next year. And we can sort of see the complete picture of what's happening in the space with the public data. So on to DeFi taxes, because I'm sure that some of you are yield farming this summer and are going to actually need to know this. So there are some gray areas in DeFi, which is sort of the starting point. However, the IRS has provided 2 rounds of question and answers, which can either be directly applied to decentralized finance transactions, or they can be extrapolated with fairly good confidence as to how the IRS is going to view these transactions. So as we mentioned, sort of the overall, they either fall into capital gains and losses or ordinary income, depending on the type of transaction. So trades between tokens, it will be the same as crypto to crypto trades, taxed as capital gains. So if you're trading Ethereum for DAI, that's still going to be a capital gains 8949 reported transaction. I love your interest earnings are typically going to be taxed as income, and airdrops are typically taxed as income, although the IRS has sort of in its specific guidance on airdrops, they've sort of used the more technical form of airdrop definition as hard forks being taxed as income, whereas the colloquial use of airdrops is simply receiving tokens is not necessarily, especially in cases where the individual did not ask for the tokens. There's some gray area there, which they've discussed in conferences, but not given specific written guidance on. So yield farming, governance, and incentive tokens, those are going to fall in the income tax category. A large portion of any yield farming strategy, of course, is collecting the protocol tokens. So your uni tokens are going to be taxed as income if you got the uni drop. If you're on Yearn, your YFI tokens, your comp tokens, your BAL tokens, all of those will be taxed as income. And so if you received the uni tokens, at the time of receipt, it would be taxed as income. However, if you decided to hold those tokens for 6 months before you decided to trade them for ETH and then traded out for US dollars and cashed out, then the transaction when you traded it for Ethereum and then maybe subsequently traded it to US dollars, those would be taxed as capital gains transactions. So you're going to have this both the income initially and then the capital gains in the longer run. So if you were providing liquidity, then it may be taxed as income or capital gains, depending on how you are receiving the earnings. So here, the nuance is going to be whether you were receiving more of a token or if the actual token itself was increasing in value as your reward. So if you were receiving more tokens as a result of an incentive for providing liquidity to a platform, then those are going to be taxed as income, the same as the governance tokens. And if you were receiving the incentive for providing liquidity by an increasing amount of the tokens, so if the tokens themselves were increasing in value, those earnings then would fall in the capital gains category. The same as just, if you held Bitcoin and it increased in value, then that would be capital gains as well. So it's sort of consistent is the overarching theme. And then, so under circumstances, loans are actually a useful tool for traders because under circumstances, they wouldn't incur taxes, right? So the nuance here is if the crypto you put up as collateral is not sold or exchanged, and also if you're receiving the same token in return for the collateral you put up. So if you put up ETH as collateral and received ETH back, in that specific case, then you wouldn't have a taxable event. But so there's some catches here, of course. If there's a margin call, so if you have a margin call and you don't add more collateral to resolve it, then you actually would have a taxable event. Or if there's the case of liquidation of the loan, then then you have it's treated as a sale. And also, if you receive another token back in exchange for the collateral, so instead of ETH for ETH, if you're receiving DAI in exchange for ETH, then you might also have the capital gains tax because it's a trade, right? So it's sort of the same as if you were trading crypto on a centralized exchange, then here it would also be a capital gain or loss. And so one thing that I think is really cool, just having sort of a finance background, is rebalancing taxes. So the neat thing about portfolio tokens is that if the rebalancing is automated within the portfolio token itself, like TokenTax, then you would be taxed on the capital gain from the time when you purchased the token until the time that you sold the token, but not on the automated rebalancing in between that. So unless you force automated rebalancing actively as a trader. So if you were to do the same thing outside of a portfolio token and make the same portfolio yourself and do the rebalancing manually on your own, you would have taxable events for all those rebalancing that would need to be reported. So the net result, right, would be the same, right, because you're still going to have the same portfolio overall gain or loss, but your reporting would need to be line by line, all of the transactions in between. So it's more of the reporting, extra reporting, right? And then on gas fees, so normally we just talk about fees, but this year, since like in the month of August and September, each month itself, there was over 100 million in gas fees both months. So we felt that we have to specifically address that because it's significant. And so on the form 8949 for capital gains and losses, there's also columns for fees, and you can take out those fees from your overall gains, which will help out traders who were paying significant gas fees in the late summer. So either you're going to be deducting the gas fee from the sale price, or it's included in the cost basis. So it's either an increase in the purchase price or a decrease from the sale price for those trades. And that's a big money saver probably for a lot of our yield farmers that they'll be able to take next year for their taxes. So, and another thing that's more of a public service announcement is that there's things you can do before the close of the tax season to save you a lot of time and effort and money next year when you actually file your taxes, which a lot of people don't like to talk about or think about taxes in December during the holidays, but it actually is really